Now let's review an income statement, the second financial statement that firms are required to report, typically every quarter or maybe every year. And it shows a company's performance over a period of time, kind of in very general terms. So usually over 1 quarter or over 1 year. So maybe between January 1st, 2018 and January 1st, 2019. An income statement shows a firm's income over a particular quarter or year. Income is nothing but profit. So how do we find profit? All revenues minus all expenses, right? And so an income statement summarizes revenues, how much money was spent, and what the resulting profit or income was for that particular year. This is an example of, a rather simplified income statement. It always starts with revenues, also known as net sales. Sometimes this is called sales revenue or net sales revenue. And then everything that follows is with the minus sign. So that's all expenses. So when we take this sales revenue and subtract the cost of goods sold, which includes things like paying money to suppliers, utility bills to produce our product that we are selling, paying wages to employees, and so on. When we subtract that, and then when we also subtract depreciation of the assets that were used for production, we get EBIT, which stands for earnings before interest and taxes. Then we further subtract interest on loans, and that gives us our taxable income. Taxable income is what we need to pay taxes on. So not sales revenue, but only taxable income, a much smaller amount. Let's say the tax rate is 34%. Then we take 0.34 multiplied by our taxable income. Let's say it's 624 millions. And that gives us 212 millions of dollars. And when we subtract the tax amount, we get net income. So net income is technically the last item in an income statement. And the reason there are 2 more items, dividends and addition to retained earnings, is because this is what the firm would then be doing with its net income or profit. So it can use all of it to pay out dividends. Or, like in this example, it actually doesn't distribute all of its profit among stockholders in the form of dividends. So only part of the net income is paid out as dividends, and the rest is retained. So this amount, the retained earnings, is then added to the balance sheet under equity on bottom right. So to summarize, in an income statement, the first item, the first row is the revenue. Everything else is expenses. And when we subtract expenses from the revenue, we get the profit for the year, also known as net income. Just a little detail about income statements. So let's say a firm sells $500,000 worth of product in some year. But let's say a lot of this was sold to customers who used their credit cards. What this means is that maybe by the end of the year, only part of this amount of money was collected in cash, and the rest will be paid shortly when the next year begins. So how much do we need to put in the income statement under revenues? The full $500,000 worth of product that was sold, or only the amount of cash that has already been received? So the answer is the full amount. And so it's good to keep in mind that little detail, that this does not necessarily reflect the true amount of cash that was collected during that year.